Hey Money Guy family, it's your host Brian Preston back with another episode of Ask the Money Guy. But what are we going to be covering today?
That's right. You guys have financial questions. We've got financial answers for you. Today we actually have two questions that were so close we figured that we would share both of you.
It's Brian Preston, the Money Guy.
Right. So the first one actually came from Twitter, and this is from @GarrettD757. And this is what Garrett said. Home improvements and or additions such as detached garage, mother-in-law suite, swimming pool. Positive expense or financial disaster, loan versus cash. All those were multiple questions. And then we also had a question come in from YouTube, and this is from Adarsh Sani, and she said, is it better to save money or use save funds for home renovation or invest to save money in mutual funds and use a HELOC for the project? So I think the underlying question here is, if I want to improve my home, how do I go about thinking about it? And more importantly, how do I pay for it?
Home renovations.
Home renovations.
Man, they want the who's, the whens, the whys, just the hows.
That's
so
right.
Let's do some Money Guy love on this. And by the way, I love watching. There is nothing better than a weekend day where you have no other obligation and you turn on HGTV and you just sit there and watch all these renovation projects. I mean, because it is so fulfilling to watch something that's old, that's unused, and then in a matter of 60 minutes, they were able to convert this thing into where it's usable space, it's brought up into modern times, and now it's a showstopper.
That's right.
So there's a reason we all kind of look at this and we go, man, we could do this for ourselves. But once again, there's a separation from what is portrayed and the reality. And I think the biggest thing, just to go ahead and pop this balloon, is that people think when you do a home renovation, you have to first think about the why. And I think a lot of people think that they're making money. I even use the word investment when you do a home renovation. Is that the reality, or is that just for the people who are on a home improvement show?
Well, I was going to say, I think the reason that most people think that is they watch a show where somebody goes and finds just this dump of a house, and they go buy it and they do a renovation, they turn around and they make a gazillion dollars doing that, and they make it look so easy. But what we've actually found when we started doing some research is that most home renovations aren't an investment. They actually have a value losing proposition. There were some populars we looked up. If you wanted to add a garage onto your house, they say the cost of adding a garage, when you go to sell your house, you actually only recoup about 64% of the cost of doing the garage. For a kitchen remodel, the number is actually 70%. So you put $100 into your kitchen.
Right.
When you sell it, it's only worth $70 more. A wood deck is about 77.3%. And here's the big one, because everybody knows if you have one of these in your backyard, your house is just going to fly, right? It's just going to sell. When you add a pool, the cost that you recoup when you sell the house is about 7% of the initial cost of putting the pool in.
In other words, it potentially is causing more damage than good
exactly
to
right.
the resale of your house. So all those things, you heard none of them equaled 100%. Now that doesn't mean that, because you see some flippers and all these other things, and I got to tell you, I think the reason a lot of these home improvement shows can show a profit is because they have all these sponsors that are donating. I mean, when I hear, and I love Chip and Joanna, but when I hear they can do a whole kitchen for like $13,000 to $15,000, I'm like,
Waco's a little bit different.
Like,
it must
I
be,
think
right?
my appliance package might have cost that much. So, it just doesn't fit with the reality of the situation. So do not do this. Go into this with the expectation of making money on it.
Sure.
You better make sure that the why is more of what's driving the situation. And when we talk about the why, I want to know, are there other benefits besides the money that we should take into account? First of all, happiness. Are you going to get some type of happiness or fulfillment or benefit that outweighs this actual loss or cost? The other thing is you might have a family situation that plays into those things, and lastly, a fatal flaw with your house that you've got to get this fixed just so you get the happiness as well as eventually have some market value. Examples of that, I mean, I'll tell you, is that you hear about people who have 3 and 4 bedroom homes that only have one bath. Maybe they're historic homes that were built in the 50s, the 60s, and they have one centralized bathroom. Right. That doesn't work anymore. Yeah. So you better make sure you have the bathrooms that are going to fix that fatal flaw. I have a neighbor that just put a whole separate detached garage And I got to tell you, I think it is a brilliant investment because his property's set at an intersection where when people came to the three-way stop, their light shined right into his backyard. You could see right into his backyard. He put in this detached garage. Now all those flaws with his property,
now, right?
He's got complete privacy. He's got livable space. He might even be able to get some rental income down the road because I think he's going to have some upgrades and other things to the structure. So all these things make it where the why and the benefits outweigh the cost of what went into it.
So you're saying doing a renovation, you should never go into it thinking, oh, I'm going to do this to make money. There has to be something else around it.
I think so. It's just like, and I'll go ahead and I'll confess, I have a swimming pool. I grew up with a swimming pool, but I have an autistic daughter that this is one of her great joys is swimming in the pool in the summer. And as a family, we get so much enjoyment. I recognize that probably 93 cents on every dollar I spend on that pool is not generating a benefit. But I think
that's okay.
The happiness, and because I built this house knowing I was going to live in this for 20 years, 30 years, maybe even longer. So I'm not so worried necessarily about the financial because I consider this a use asset.
So that's the why. So the next question we have to kind of answer is, okay, well, how do we pay for it? And the first thing that we want to say is, just like any major purchase, before you decide to make that purchase, you need to kind of measure twice, put some time in, think about it, start building up, start saving for it, because what you don't want to do, watch an episode of Fixer Upper, decide you're going to renovate your house, and the next Monday you go and start buying supplies. That's not the way you want to approach that decision.
And I think the part people are trying to figure out, is this a cash transaction? Is this a loan? And we just had a new tax policy change. Is this thing even deductible? Am I going to get some tax benefit out of it? So let's kind of take this step by step. First, if you are a person that can afford to pay cash for the transaction, you have enough in emergency reserves as well as cash that you've been kind of earmarking for this, should you pay 100% cash? I actually love the thought of people being completely debt-free and paying cash for things, but I also want to make sure you're not getting things out of order. So go back and check out our episode on financial order of operations, because if you're not covering the basics of maybe this project's going to drain you of all your emergency reserves, I don't know that that's ideal. If you're not doing something to save for your future with financial independence and retirement, I'm not so sure I want you draining all of your resources instead of investing for tomorrow in your financial independence. So definitely go check out the order of operations to make sure that financially you're not doing something wrong before you take that big chunk of money. But if you do, maybe you're on the latter part of your triangle of building the order of operations, and it's between you speculating with this money or paying cash. Let's get you out of debt and just pay straight up cash for it. So that's the people with cash. Now, how about the other people that are probably going to do some type of either finance, some portion of it? Let's talk about that a little bit. Here's what I would ask you. We went through the numbers. We know that a good number of home improvement projects probably aren't going to have a return on investment of 100%. They're probably going to be somewhere between 60 to 70%. So it'd be nice if you could have 30 to 40% cash to put towards your project to kind of cover that shortfall, and so you don't get into a negative equity situation just in case maybe your career changes or something, you have to move and sell this house. You don't want this project being something that was a detriment to you through this process.
That's exactly right. I think about it like this, Brian. We talk about all the time when someone goes to buy a car, especially when you go buy a brand new car, as soon as you drive it off the lot, they say just value evaporates, it disappears. That's why it always makes sense to put a down payment. You can kind of think of a home renovation the exact same way. As soon as it's done, you're probably not going to get out of it the cost you put into it. So it makes sense to have some skin in the game, just like you said, to avoid that negative equity situation.
And then the last thing I just want to kind of touch on, because we do have a new tax law that went into effect in 2018, and it's completely changed the way home equity lines kind of were impacted. We all know in the past, 2017 and prior, you could have a mortgage of up to $1 million, and then you could always do $100,000 of improvements to your house that would be deductible.
That's right.
That's gone away. Now what has actually happened is that the government wants you to combine all of your mortgage debt, and it has to, for single and married couples, it can't exceed $750,000. So let me give you an example. You have a $500,000 mortgage on your house, now instead of having a $100,000 home improvement cap that would be deductible, you could actually have a $250,000 project if you were doing a huge renovation.
Sure.
That potentially could still be tax deductible to maximize that $750. But it's one of those things where now you have to look at it in combination and look at the cumulative number instead of separating it. They were not two separate transactions like they were in the past. So here's the kind of the closing thoughts on this thing. As you heard, this is not, it's like most thing with finances, this is not all about the nuts and bolts of a calculation. It's not just a numbers game. You better make sure that you understand the why and what the benefits will be for you even above and beyond the financial calculation. And if those numbers are big enough, or at least the measurable aspects of happiness, fulfillment, family necessity, because that's the other thing about family. We talked about what happens, because I had one of the questions on there was mentioned in-laws.
Sure, yeah.
What happens if you've got an illness in the family and you've got to have an in-law that's moving in with you? That's, it's no longer a want. This has turned into a need.
That's right.
So some of the finances go out the window. You have to, because the need exceeded the cost.
That's right.
So just make sure you're thinking about all those considerations. And then once you know that the why is big enough to make this thing happen, let's go ahead and get the money worked out. Figure out that cash, figure out how much that loan, and then, as Bo has already said, measure twice, cut once, and do this thing right.
And I think, I just want to mention, one of the things we didn't say was if you leave your job, rather than rolling over your 401k, you cash out your 401k to go do a home improvement. We didn't mention borrowing from your retirement assets or liquidating retirement assets. That would be getting the order of operations wrong. Now, obviously, if there's something with the in-law suite, there was a need, you have to do what you have to do, but a home improvement is something that's kind of done out of excess after you've done some basics.
Guys, hopefully you love that we're sharing information like this. Please continue to use hashtag #AskTheMoneyGuy on all of our social media platforms. And then if you like this, you're like, man, these guys are completely giving away free advice. That is so awesome of them. Realize this is all part of the abundance policy that we have, is that we know if we love on you, give you ideas to grow and invest into yourself, at some point you're going to say, I need somebody to look over my shoulder and take this relationship to the next level. We're hoping you'll repay us at that point by letting us have a chance to be that person you reach out to. Go to moneyguy.com, go to aboundwealth.com, go to our Contact Us page. We'd love to hear from you. I'm your host, Brian Preston, with Mr. Bo Hansen. We'll talk to you soon.